Hello, sir. Good afternoon, sir.
Yeah, we'll wait another 5 minutes, Varalakshmi garu.
Yes, sir. Yes, sir. We will wait, sir. Okay, sir. We'll start the session after 5 minutes, sir. Meanwhile, participants, please join immediately. Sir, shall we start the session, sir?
Yeah, we can start the session. I am ready.
Yes, sir. Yes. So,
Yeah.
good afternoon, participants. Actually, yesterday we had some echo is coming. Yeah. Yesterday, Dr. Airala Lokanand Reddy sir had delivered lecture on spreadsheet modeling. It was really very excellent. And today, sir is going to deliver his lecture on introduction to financial analytics and with some use cases and demonstration also. So we really happy to have you here today, sir. So I request you to start the session, sir.
Thank you, Andy. Good evening, participants. Once again, I think yesterday we had discussed, certain issues in financial spreadsheet modeling. So today I'll take you through certain introduction to financial analytics. So, like this is a program where we wanted to introduce the different topics in analytics. Some of you, it may not be close to your heart. Those of you are from management, but from marketing, HR, but still you can actually have a glimpse of it, and then I think it should be of some interest to you. So I'll be taking you through a formal presentation first. So here and there, when I want to show you something, probably I can come back and show you an Excel sheet or some other thing. So let us start with I understand basically you've been given that there are three types of analytics. So some introduction to analytics was there, right? So you understand that there are three types of analytics. What are the three types of analytics? So I'll just keep your chat box open so that I can see if some of you are typing. So was there a session on introduction to analytics already there for you? What are the popular three divisions in analytics? Or even you would have read in the recent literature, wherever you talk about analytics, we talk about three types of analytics. Predictive analytics, yes. Descriptive, predictive, and prescriptive. Good. So thank you for that input. So there are three basic types of analytics: descriptive analytics, predictive analytics, and prescriptive analytics. So what is the difference in descriptive analytics? We describe, right, what has actually happened. In descriptive analytics, we describe what has actually happened. It is more like a post-mortem. It is like the event has already happened. We try to summarize this happenings in the form of certain metrics, mostly statistical in nature. So you can relate this descriptive analytics to your descriptive statistics. So the descriptive statistics include measures of central tendency, mean, median, mode, and then also measures of dispersion, like you have range, standard deviation, quartile deviation, and mean deviation, and also measures of shape like skewness, kurtosis. So this is statistical measures of description. And apart from this, any metric that you calculate, right? Any parameter that you would estimate and calculate, compute based on a data that is already available to you and it has happened in the past. So that come under descriptive analytics. So coming to the predictive analytics, we try to predict. We try to look into the future. So from descriptive to predictive, from the past to future. Right? So we try to estimate what is the stock price. We try to estimate what is going to be the sales. Right? We try to estimate who will become a defaulter. We try to estimate how much is going to be the competition. We try to estimate, given one variable, what will be the action of the other variable. Right? So all this prediction, which is related to the future, right, is called predictive analytics. So you're basically based on the past data, based on the existing data, based on numeric and non-numeric data, we try to tell what is going to happen, right? That is predictive analytics. Then coming to prescriptive analytics. So what is prescriptive analytics? Can you please respond? Having understood descriptive and predictive, what is prescriptive? What is prescriptive analytics? So you don't get any prescription? You don't get any prescription from anybody? At least when you go to a doctor, you will get the prescription, right? What should we do? Yeah. Prescribe plausible alternatives. Yeah. Give a course of action. Prescriptive analytics actually give a course of action. That you give them an advice. Do this. Do this way. Right? Either you accept this application or reject this application. Right? Or if you are investing, you invest in this proportion. This is called prescriptive analytics. So if you want to spend on advertisement, spend this much. So in prescription means giving a course of action, giving direction, giving what needs to be done. But this is how the descriptive, predictive, and prescriptive analytics are based. Now, what I will try to do now, I'll try to cover these 4 areas in finance. Accounting, the corporate finance. Basically, the corporate finance is what we popularly call it as financial management. Right? The investments are also called as what? The security analysis and portfolio management and things like that. And financial services. So the financial services include banking, insurance, right? Credit cards, right? Then leasing, hire purchasing, credit syndication, right? All these are financial services. So now these 3 items I'll try to cover in these 4 subgroups of financial management or finance. So that's where we get into the analytics. Now, towards the end, I would also like to show you 3 examples of 2 from portfolio selection, then 1 credit card default prediction. But now that I'm sitting in office, I don't have access to SPSS. Otherwise, the SPSS software, we would have shown you the yes. So I would have shown you the how we run something like discriminant analysis in SPSS. But however, I have the screenshots, though I don't have the access to the software. Maybe I'll show you the screenshots. So we'll start with descriptive analytics. As I have already told you, the descriptive analytics deal with trying to calculate some metrics. Trying to calculate some metrics based on some data. And analytics is not new in finance, except that today we keep talking about it a little bit more here and there or it is the old wine in the new bottle as far as finance is concerned. Right from the beginning, by nature, the subject called finance is analytical. That means the finance deals with numbers, not just deals with numbers. So it deals with numbers in such a way that these numbers are put one against the another and to create a meaning. And in most of the cases, finance by nature is also prescriptive. Prescriptive in the sense we decide how much to invest in each of the shares to build a portfolio. We decide whether somebody should be given a bank loan or not, a credit card or not, home loan or not. Then we decide how much cash balance we should maintain. Then we forecast the different cash requirements for the next 3-4 years. So we prepare the detailed project reports, basically where the cash flow estimation, cash flow projections are the the crux of the whole report writing. So whether you talk about descriptive statistics, either talk about descriptive analytics or predictive analytics or prescriptive analytics, all these things existed in finance for a long time. And I also today worry the way the financial analytics term is being misunderstood by most of us as having to do with Python R programming alone. No, the Python R programming, algorithmic trading, machine learning are there, in most of the walks of the life, but they are not the only analytics that we have to see. And especially in finance, this portion form a very minuscule, a portion of the whole finance faculty, or whole finance as a subject. So the stock market is not the whole thing, but the stock market is the first thing that has captured this fever, and it's natural because it is you have movies. This is a colorful field. So in finance, the colorful field is the stock market. So anything new that comes, and in stock market, people are in constant search of answer for a question that was not none of us were able to answer for quite some time. How stock prices gets determined. So people are really crazy in looking at the new things that come up, whether this question gets answered. But the fact remains that it's not going to be answered with any amount of technology that might crop in. So we'll be also looking at this aspect as to why stock market determination is very simple, somewhere in between during our lecture. So let us start with the descriptive analytics. So I gave here a small table how descriptive analytics gets used in the areas. See, for long you have known that ratios are a very important, item in the financial analysis, right? So let us go here. So what are ratios? The ratios describe the relationship between two items. Basically, the turnover ratios describe the relationship between the assets and the turnover. And they are also called as asset utilization ratios or efficiency ratios. And you see, such a number of metrics already existed even before we started talking about the word called analytics. These are all nothing but the analytics. So what you see on the board are nothing but financial analytics, right? So the calculation of ratios has been a very, very long story. And just to take you through the glimpse of that, you have turnover ratios, then you have profitability ratios, which measure the relationship between the returns and sales or the returns and capital, right? So the two types of profitability, the profitability that bothers the managers So they are worried about how much profit they are making on sales. But what is important is that the investors are worried about how much profits they are making on their investment, right? So this way, the profitability ratios give a glimpse of what is happening in the organization in terms of profitability, and this has been a very time-tested analytic. Then you have what are called as liquidity ratios, which are supposed to measure the ability or the comfort with which an organization can meet its current liabilities using current assets. So quite a good number of ratios are there, right? Then finally the leverage ratios. Then you also have coverage ratios, right? Which will measure the leverage ratios will measure the relationship between the debt funds and the total funds, or it is measurement of the proportion of debt in the total capital, which is a very, very important indicator of how levered is the firm. So then you also have the shareholder analytics. So they're in terms of the market related ratios. So the right from earnings per share and book value per share, right? Then total yield, dividend yield. So these are all some of the descriptive analytics in accounting area, right? So I'll just show you how this can be done. For instance, let me take you through accounting. Then you go to ratio analysis. Yeah, so here we go. See, here we have a set of ratios. The data is here, right? I just made it for a 3-year period. You could have done it for a 5-year period as well. So now here we have all these ratios. So depending on each ratio, right? So the particular ratio that you want, you can have the base. This is based on the data that we have here. So you just type the number, then you get see the inventory turnover. Then you have debtors turnover. If you want the days in inventory holding, if you want the average collection period, right, or current assets turnover ratio. So these are some of the ratios that have been calculated. Here you see, whatever I have discussed, all these ratios are here. Similarly, you can also have a look at the shareholder analytics. So the shareholder analytics, I have shown you a lot of them. So simply you get all of them here at one go. Right? Now we don't have time to get into the individual meaning of all this. But the point that I'm trying to make is that a lot of descriptive analytics are already available in finance. The only thing is today we have big data. Today we have data not just for the last 2-3 years, but we have data for so many years. So now the present day analytics, the concept is how you leverage this data so that you make meaningful conclusions out of it. Right? These are the descriptive analytics in finance accounting area. Then the cash flow statements that you are aware of, then you have funds from operations, funds from investment activities, then you have funds from financing activities. Right. So I would have shown you the cash flow statements as well, but due to lack of time, we'll skip this. Or you just want me to show, I can show you. So now here is your exercise. Once you have this exercise, right, then you go and enter this data as to what are the different accounts. So this is our system generated. We need not do anything. The system will do it. So then you have cash from operations calculated. Then you get finally your cash flow statement. Right? So some of you from finance appreciate the importance of cash flow and funds flow statements in financial literature. So this is again a descriptive statistics that is there in the accounting area. Similarly, those who have some knowledge of security analysis and portfolio management would understand. So we have what called exposed security returns and exposed security risk, right? Similarly, you have portfolio returns and portfolio risk. So this portion is the descriptive statistics. Certain examples that I have shown that you have in your accounting and portfolio management, and these popular portfolio performance evaluation methods, right, is another descriptive statistics that we have. You have change in NAV method, then you have total returns method, and most of the business dailies publish this, on a what you call day-to-day basis in their journals. And you have what is called a Sharpest measure, the trainers measure. Those from finance would understand what I am speaking, right? The Sharpest measure is the actual portfolio return over the risk-free return divided by total portfolio variance. And the trainers measure is the excess return over the risk-free rate divided by beta of the portfolio. And of course, you have got the Jensen's alpha, right? With this, I have just shown a glimpse of descriptive analytics. Now, I just want to pause for a while. First, I want people from finance to respond. Have you ever thought these are part of analytics? This is what basically, most companies do in the name of consulting. So what they would do is they will prepare these set of ratios, but the calculation of ratios is not just a big thing, but what you interpret out of that is the major thing. How many of you know something called DuPont chart? How many of you know something called DuPont chart or DuPont analysis? Are there some participants from finance area? There are not participants from finance area.
So few participants are there, sir.
Pardon?
Few participants are there, sir.
Few participants are there. Yeah, I want them to respond. Somebody like Inakallu Malyadri is speaking deliberately or is by mistake his audio is on? Say how many
Pardon, sir?
viewpoint analysis?
Hello, pardon, sir?
Yeah.
How
Viewpoint
many?
analysis. Have you heard of viewpoint analysis? Malyatrigar. So Malyatri's audio is unmuted by chance.
Voice number.
Sir, you can post your answer in chat box.
Yeah. Nobody is posting anything there. That's why I'm wondering. The people are there sitting before their computers are they're jolly well relaxing because finance is not their subject. Anyway, to appreciate what I've told you so far, you need not be a finance specialist. These are all the minimum that as management professionals or management teachers we should know. But what is important is today we can't sleep over data. See, the data has to be properly utilized. The data has to be properly. So, yeah, somebody says he's from HR and marketing, but he has an idea on viewpoint analysis. Very good. Thank you, Ramon Redgar. So now the point is, like descriptive analytics is about the past. Naturally, what I've discussed is also not having that kind of the anxiety and vigor in you. So, but going forward, I'll take you through a few examples of how we use the optimization techniques in finance, so that would be of more interesting stuff to you. Okay, so here we rest our discussion about the descriptive analytics. Now let us get into predictive analytics. In predictive analytics, I have told you projected financial statements has been there as an important activity in the area of finance for quite some time. So the projected financial statements means we all know that once we have an organization up and running, then once in a while the accounting period concept tells you that you will have to prepare your profit and loss account and balance sheet. You have to prepare your income statement and see what's happening, and then balance sheet. But then the projected financial statements deal about the data that is relating to the future. So sitting today, I should be able to predict what will be my sales for the next 3-4 years. So what would be my cost of goods sold for the next 3-4 years? What would be my gross profit next 3-4 years? So this is called projected financial statements. For example, if you have a statement like this that I have already shown you, something like see, if you have a projected financial statement like this, so what we're talking about is say something like this. So this will become your actuals. Whereas this will become your projected. Actual, this is past. So this is projected future. So for instance, let us say you have your statements for 2018, 2019 and 2020. Now we are projecting it for 2021, 2022, 2023. Now these figures which you need to fill here, which you have to come up with, shall become the projected financial statements for the coming years. Have you seen something like this before? So where sitting today, I have the past figures. Based on these past figures, then I will have to arrive at what will be my sales in 2021, what will be my sales in 2022, and what will be my sales in 2023. And based on that, I will also have to come out with what will be the cost of goods sold in these years. Based on that, I will come out with what is the gross profit in these years. So this is part of your projected financial statements. And remember, in such big projects like airports or the ring roads or toll roads, these projections have to be made for a period of 10 to 15 years. That means sitting today, I will come out with what will happen in the next 15 years along with the figures and facts. This is a pretty useful technique in your finance, and then it's a technique which is in high demand, right? Then of course cash budgeting or cash flow estimation, you are all aware that sitting today I'll have to project my what we call the cash estimations, cash requirements for the coming so many years. So that is called cash budgeting and cash flow estimation. This is part of predictive analytics. Then you have the stock price estimation. So this is where today we have most of the glamour that is coming into the financial analytics arena. So we used to commonly look at mostly the structured data. The structured data means the data that has been purely organized, that has been in the columns and rows. So that is called structured data. Mostly the financial data is, basically it is structured. So we cannot have unstructured data. But today we are breaking this myth. We are breaking this particular the age-old practice and going forward and trying to see how we can sharpen our saws so that we analyze the unstructured data also. The unstructured data means the comments, the social media data, the Twitter handle data, the Facebook data, the WhatsApp data. Now people are getting to analyze all this data and then whether this data has got something to do with the stock market prediction. So today we have powerful machine learning algorithms that scan the World Wide Web, that scan the internet and come out with certain suggestions so that we do some stock market prediction. As far as the structured data is concerned, we have these methods already in vogue, and at least some of you should be aware of these methods. that the auto-regressive techniques, moving average methods, especially when you are dealing with the time series data, right? These models like Arch, Gorch are already in your knowledge if you are in the finance domain. And we also have the K nearest neighbor algorithm and also neural network techniques. And mostly these are trying to predict certain things based on mostly the stock price based on the structured data. Whereas the machine learning algorithms, which predict the stock market prediction. So we have these techniques called bag of words, named entities, right? Object knowledge model, OKM, right? The point here is, in spite of all these research efforts, till today, no specific method has been developed, right, to correctly and accurately predict the movement of stock prices in the stock markets. Now tell me, is this a boon or a bane, or will this remain as unreachable fruit in the financial research? Will we be coming out with a particular method someday which will predict the stock price data? Is stock price data prediction possible at all? If somebody says he can do it, can we trust him? So why are we not able to come out with a super formula to predict the stock prices? So can I kindly answer this question? Reflect upon this. Can there be one method to predict the stock prices? External factors, like is it external factor or internal factor? Jnana Prasuna, is it external factor or internal factor? So the external factor, because stock prices depend on external factors, that but then what is the main? If you were to describe, tell me what determines stock prices. If you start from a layman's language.
Yes, sir. Both the internal as well as external factors which influence to represent the stock prices. Internal factors are company performance, financial position, government support, like different internal factors will influence. External factors means the stock market will influence for different external factors. For everything, it will be discounted. That's what.
Okay, very good. It's a good analysis that I got today. But Prasanna, just hold on. We would take this discussion a little forward. And fortunately or unfortunately, you're touching my most interesting. See, there are certain external factors, like she has noted whatever happens in the rest of the world. There are certain internal factors, that is external means should I say outside the company? As a broader description of the external factors like the foreign exchange changes, inflation, etc. Okay. So then you have some internal factors. Internal factors, right? Let's say inside the company or within, which is in the control of the company. So then you are getting the stock price. So these two influence stock price. Okay. Is this model complete, Prasanna? I mean, shall I just, if I put two arrow marks, will my stock price prediction model be complete? Are there any important elements that we are missing? So now let me put one arrow mark like this. Yeah. So should we add any more in this? Or let me be very specific and direct. Is there somebody in between the external factors, internal factors determining the stock price? Is there somebody in between? If there is somebody in between, who is he? What is this human action I am talking about? Yes or no? There is a human action who are actually deciding to buy, right? Let me say, instead of buying and sell, buy or sell decisions. There is a buy or sell decision that is happening between the stock price becoming something and the external internal factors influencing it. In between, we have a layer called the human action, where the human mind is calling, okay, investor behavior. Yes, investor behavior is little advanced or little, an extension of this, but you take a pure rational investment behavior, pure rational action. See, if at all you come out with a formula, that is able to predict stock price, what will happen to this area? So here, when I say human action is there, what actually I mean by this is, some decide to buy, and some decide to sell. Some decide to buy, and some decide to sell. This is the human action that is happening between the information and the final outcome. Now tell me, if you have a super formula which is able to predict the stock price clearly, if you have a super formula which will predict the stock price clearly, then what will happen? Then what will happen? You say somebody has come out with a super formula, just you feed data into that formula, it will tell you how much should be the stock price. Then what will happen? What will happen, especially in this space? What will happen here? If I have a super formula that is going to predict, the exact stock price, then what will happen here in this box? Have you ever thought about this? I'm addressing the most important question: why you don't have a super formula to calculate stock price? Even after so many years of research, even after so many inside trading, Prasunna. See, somebody is coming out with a formula. He has published that formula. Let us say it is available in the internet. Only thing is you feed data related to a particular stock, it will tell you how much should be the stock price. And this formula has been validated. It is found to be correct. Then he also got the Nobel Prize. Let us say something like that happened. Now this formula is available in the public domain. Then what will happen in this box? I am giving you a straightforward question. If at all there existed a super formula to compute the stock price, given the external and internal factors, what will happen? Because of time, I'll have to tell you the answer right away. What will happen? Will, after this formula is out, after this formula is available, will somebody decide to buy and some others decide to sell?
Sir, it won't happen, sir. It won't happen in stock market, sir.
Pardon?
It won't happen in stock market, sir.
No, that's what will happen. Here, be specific so that others understand. Once you have a super formula, do someone decide to buy and some others decide to sell?
It is going to be stagnant.
It becomes stagnant.
Stagnant.
If everybody knows what is the value of a stock, either everybody will buy or everybody will sell. Some people don't buy it, some people don't sell it. See, you have a stock which is let us say you have a stock, sorry, say you have a stock whose price is 300 rupees. Why somebody is buying it? Why somebody is buying it at 300? And why somebody is selling at 300? So the buyer thinks, right, the actual value is more than 300. The buyer who thinks the actual value is more than 300 and it is available for 300, so he is buying. What seller is thinking? The seller is thinking that the actual value is less than 300. Seller is thinking the value is less than 300. The buyer is thinking the value is more than 300. And that is why you have the trading taking place. There is a difference between price and value. The price is one. Price is the rate at which it is bought and sold in the market. But value is one that is calculated internally by every individual. So now, because the values are different, there is buying and selling in the market. If there is a super formula, what it will do? It will make price is equal to value. That there will not be price, there will not be value. Because I believe the formula is correct. And I think whatever the formula is saying is the value of the stock. And if everybody is thinking it is 300, nobody will buy it, nobody will sell it. Except that they have other reasons to buy and sell. The trading will not be driven by the demand and supply. So, whatever may be the amount of analytics that we come out with, whatever may be the advancement, you call it machine learning, you call it, automated buying and selling, you call it, algorithmic trading, whatever may be happening, right? Finally, the result is going to be very, very simple. The result is going to be that that no specific method has been developed to correctly and accurately predict. This remains the fact. If we were to meet again and discuss about this topic, even after 20 years, this one slide will still be valid. Other slides may change, but this one slide will still be valid, that the stock price prediction can never be right made accurately with any amount of analytics. So this is one particular area which will tell you, how we are going to move forward. Now, coming to the predictive analytics, the machine learning algorithms, they perform some linear regression analysis of the old or historical security pricing data, and they are now equipped to process the unstructured data also, right? Then they determine the price trend of a given stock, right? In addition to determining the impact, there is the risk portion of it. And then they also predict the stock movement, either upwards, downwards, or unchanged. And these are popular, the machine learning algorithms. You have genetic algorithms, you have naive Bayesian algorithms. The Bayesian algorithms are based on, the most of statistical modeling based on Bayes' theorem, which is becoming very, very popular. Then you also have support vector emissions, SVMs. Right? Yeah, sorry, I thought it's not there in this slide. It is here. But despite all this remains to be the myth. Okay? Okay. Now, within predictive, I have shown you some descriptive analytics like exposed security returns, exposed security risk. So the predictive counterparts is what we call ex-ante returns, ex-ante risk. Remember, here we are not dealing with the what we call the historic data. Here, this PI stands for probability, right? So the moment we talk about probability, we are trying to estimate the probability of occurrence of those events and linking it with their returns and risk. So here also you see, here you got the actual R bar, that is the average return. Here you got an expected return. So the expected return is a probability weighted return, so which deals with the future. So similarly, the portfolio returns and portfolio risk also on an ex-ante basis. So these are your descriptive. So they're okay. So their counterparts are missing here. It's okay. Then you have the predictive analytics basically in the binomial and Black-Scholes option pricing models. If you are from finance, these are all examples of again predictive analytics where you come out with the option valuation. You come and tell this is the value of the stock, the options. And the simulation is a very popular tool that is used in derivative pricing. Coming to the last leg, which we call prescriptive analytics, where I'm going to show you a couple of examples, demonstrate. So here, this is the list where within corporate finance, you have the capital budgeting techniques like NPV, IRR, right, which actually tell you whether a particular mission has to be accepted or not. Whether a particular mission has to be, whether a particular project has to be taken up or not. Then, of course, within corporate finance, you have the, capital structure decisions, which will decide the optimal financing mix, right? Then you also have the optimal dividend ratios. You also have the optimal inventory level. You have optimal credit period to be decided. These are all part of your corporate finance. I'll just show you certain screenshot or glimpses. So this is how you use the right capital budgeting techniques to decide whether projects are accepted or not. Then the optimal financing mix. I hope the one optimal financing mix is the one which is having the lowest cost of capital, because the value of the firm is inversely related to the cost of capital, because it is arrived by capitalizing the net operating income. That's what you see the formula here. It's net operating income by KO. As KO decreases, net operating income increases. And I'm sure some of you who are from the finance background would understand there are several approaches like net income, net operating income, traditional, and hypothesis, which decide the optimal financing mix. And of course, optimal payout ratio, you have two models, the Gordon model and the Walter model. So the one that I'm showing you is the Gordon model. Just a second.
Sir, your mic is muted, sir.
Yeah. Purposefully I muted it. I had to take a call. My wife is worried I haven't gone home. Is that?
Okay, sir.
So I told her I'm getting late. Yeah. So now the the dividend payout models. All of you are aware. There is a Gordon model, and you have a Walter model. You have approach. So here, what we try to do is we try to see how the value of a firm has been increasing or decreasing, right, or staying stable based on different payout ratios, and we try to suggest, right. For example, if it is the Green Parks or whatever is the name of the company, it is better to pay 80% dividend. Sorry, it's better to pay 20% dividend. Whereas in case of NF, it doesn't matter whatever is the payout ratio. In case of DM, it's better to pay 80% dividend, because that is the payout ratio which is increasing your value, right? So these are other models that are available. Then of course, this EOQ model, I think you all are aware of how the balance has to be achieved between the holding costs and ordering costs. See, if you try to have more, quantity of ordering, yes, you would reduce the ordering cost, but because you have to store them for a longer period of time, your holding cost will increase. On the other hand, right? So, if you try to order more frequently, your ordering cost will increase, and the holding cost may be low. So you have to find out where you achieve this. The total cost to be minimum, right? So that is the point where your holding cost will be equal to your ordering cost. So these problems can be solved using the optimization techniques. Then an optimal credit period is another prescriptive analytic in what you call the finance area, corporate finance area, where you would be able to decide how much you should be lending to your people, what kind of credit period you should allow them. So yeah, we come to the exciting portion today, which is the climax. So I'll show you these two examples and then we'll close. So if you are able to see this, just read it through for 2 minutes. Yeah. Sorry if I'm going to strain your eyes. I'll just give it one reading, that's fine. Then we'll solve this problem and we will leave. Already people are asking for feedback link. So I should close it as early as possible. But this will be an interesting stuff. Just read this for 1 minute. Then you can make notes somewhere if you want the important points. So actually I should have shared this with you, but I couldn't do it. or at least if you have time, I can share it right away. This file, where is this file? Just give me a second. Yeah. Just give me a second. I think I'll be able to share this file with you. Yeah, in the chat box, I've given you this link. Just click on that link, you will be able to access that file. So others who can't do it, just have a look at it for 2 minutes. We'll solve this problem. It might take another 10-15 minutes, then we can leave.
ఇంతకన్నా మంచి పోలికేది నాకు తట్టలేదు గాని అమ్మో ఈ లవ్ అనేది బబ్లు గమ్ము అంటుకున్నదంటే పోదు నమ్ము ముందు నుంచి అందరన్న మాటే గాని మళ్ళీ అంటున్నానే అమ్ము ఇది చెప్పకుండా వచ్చే తుమ్ము ప్రేమ నా పలేవు నన్ను నమ్ము ఎనగానే ఎదురు చూపుకి ఇంతకన్నా మంచి పోలికేది నాకు తట్టలేదు గాని అమ్మో ఈ లవ్ అనేది బబ్లు గమ్ము అంటుకున్నదంటే పోదు నమ్ము
Yeah, could you read this through a little bit? So now I'll show you an Excel sheet where we kind of do this problem. So So this is where I have represented that the different investments that are considered, the shares that are considered, are giving you this projected rates of return. That means if you are investing in Atlantic Oil, you get 7.3%. If you are investing in Pacific Oil, you get 10.3%, and so on and so forth. So this is one area that we should take into account. The other area is that you have these constraints. So that are stated in the case that the total available funds is, right, 1 lakh rupees, right? Then in the oil stocks, these two are oil stocks. In oil stocks, you should not put more than 50,000. And similarly, in steel stocks, Midwest and these two, in these two stocks, you should not put more than 50,000, right? Then the Pacific Oil, in this particular thing, you should not keep more than 60% of oil industry. That means if I'm putting, let us say, out of 1 lakh, I can't cross 50,000. So let us say I decide to put 40,000 in the oil. So here, if I'm putting in Atlantic Oil and Pacific Oil 40,000 put together, then my investment in Pacific Oil should not be more than 24,000, which is 60% of my total investment in the oil industry. Then in government bonds, I should put at least 25% of what I am investing in the steel industry. Let us say in the steel industry, I have decided to invest 40,000. Then 25% of that is 10,000, should be invested in government bonds, minimum. So now, who will decide these constraints? Of course, the first constraint is self-explanatory, that you might have only 1 lakh rupees, the total funds, but the other 4 constraints are based on the qualitative input of this investment. So maybe your past experience tells you, or maybe your expert advice tells you this, right? So based on whatever it is, right, you cannot invest according to these particular things. Now come back. Now I'm trying to build the model. So when I'm trying to build the model, I'm just keeping my wherewithal ready. See, for example, somewhere I have come out with the amount that I'm planning to invest. Say, for example, in Atlantic Oil, let us say I'm putting 10,000. Then I'm telling you the total. Yeah, now I'm in the meeting. Yeah. Okay. Yeah. Yeah. Guys, sorry for this sudden interruption that my network connection was lost. So I have started sharing with you an Excel sheet. Till that time I was there. You all have seen the Excel sheet, please? This Excel sheet you have seen? I started talking on this Excel sheet.
Yes, sir. Yes, sir. It was there, sir.
It was there.
Yes, sir.
Okay, this portion I talked. When did I lose my connection?
Sir, I think when you are talking about constraints, sir, steel max and how to fix the share price and steel max and first, when we are discussing those.
Hello. Hello, participants. Please wait for 2 minutes. Sir will rejoin again because sir is having some network issue at the office. Sir will join after 2 minutes. Please wait. Sorry for the inconvenience.
It will take a lot of time. Now tell me, what is the method by which this problem can be solved? Can you tell me what is the method by which this problem can be solved? Because you said some of you are not in finance. So now I am expecting an answer. What is the method by which this problem can be solved? Linear programming model. Very good. Vishwanath Garu. So you have a technique called linear programming in your operations research. Now you see the real beauty of wedding of finance and operations research. So that's where basically today we have more of analytical approach. It is not that in finance we don't have analytics. So now today what has been the trend? You apply statistics in finance. That's where you are checking out this to be more analytical in nature. Now to do this, luckily in Excel you got an excellent tool called Solver. Let me go to Solver. Now you see this problem has already been framed. So now what is my target is I want to make this total return maximum. I want to make this total return maximum. So that means set the objective to a maximum value, and then by changing which cells, by changing the proportion of investment that I should do, right? These cells. So this amount should be changed, and of course these constraints have been fit into this. Subject to the constraints, the first constraint is this should be equal to this, and the second constraint is that these three should be less than or equal to these three things. And the third constraint is the government bond should be more than or equal to G18. Okay? That means more than 25% of whatever I invest in the steel industry. Right? G18 is what I am investing in steel industry. Okay. Then I solve it. So then Excel tells me the solver could find a solution. So click OK. Now you see all this is telling me based on these constraints, right? What is the best available option? So Atlantic Oil, you invest 20,000. Pacific Oil, you invest 30,000. So the total is 50,000. So now this constraint is satisfied. That means the maximum that can go into the oil industry is 50,000. Then how much you are investing in Pacific Oil? 30,000, which is 60%. So you have not exceeded that more than 60% of investment of investments is going into Pacific Oil. So this condition is also satisfied. So this condition satisfied, and Oil Max, this condition is also satisfied. Then coming to the Midwest Steel and Huber Steel, so these two things should be less than 50,000. This is also satisfied. Then finally, government bonds. So government bonds tells you whatever goes into oil industry, steel industry, minimum 25% should get into government bonds. So now I'm investing 40,000 in steel industry, but the government bonds is 10,000. So this condition is also satisfied. So now I have satisfied all the conditions, and I got an optimal solution that if you do it this way, your return will be 8,000. So this is an example of prescriptive analytics. So quickly, I'll show you one more and I'll close. So quickly, this I'll not solve, but I've already shared the file with you. Right? This is an example of what is called as Markovitch efficient frontier. Because most of you are not from finance, I shouldn't waste your time explaining what it is. But as the climax, let me just give you that short and leave it. So this is how this construction is made based on the example again, right? So you have 5 stocks with this kind of characteristics. This is the covariance matrix. So finally, you want to generate an efficient frontier wherein you will have to come out with the weights for each of these assets. So then I have a macro which I told you yesterday we could not cover in the spreadsheet modeling. So I thought it fit. If I show you, then you would understand both. So you just click on this button, and this button will do the rest of the thing. So your Markowitz efficient frontier is generated. So this is also a part of the prescriptive analytics. So with this, I'm exactly on time and I'm stopping. If you have any questions, quickly we can take few questions. And I know it has been a little Gracken leaking today for you, but we can't help it given the specialization of the subject. So any questions?
Participants, if you have any questions, please ask the resource person. If you are having any network issues, in a sense, you can just post your question in the chat box.
Yeah, it seems that a lot of stuff today we have discussed gone well over above the head. So that's also an indication for all of us to realize where world is moving and where we are, so that the gap is known. So each one of us should try and fill the gap. So I wish you all the very best, so that you would now have realized little bit of the advancements in the financial analytics. In fact, I have not gone beyond a point. Even that itself has become a little too much, I believe. But it's fine. One has to go with the wind, and then we have no escape as long as we talk about analytics. So we should be willing to take up things as they come to us, and then it has gone beyond one's imagination how things are moving in the financial markets. So with this concluding remarks, I would rest my case. So wishing you all the very best. Finally, as is the wont, once again, any questions, clarifications, we can have a couple of minutes. Yeah. Thank you, madam, for that feedback.
Sir, thank you very much, sir, for your excellent words and excellent concept explanation about the spreadsheet modeling and also about the financial analytics. Really, you are very supportive to the JNTUA School of Management Studies, sir. From the starting, I am observing, I have been working here from the last 3 years. I have just seeing you, how you engage the class and how you involved and how your discipline and time management, everything is excellent, sir. And your knowledge about the subject and the way of delivering the content to the participants, that was really excellent. Thank you, sir. Thank you for supporting the JNTUA School of Management Studies in every aspects regarding curriculum and regarding the development and upliftment of the organization. Thank you, sir. Thank you very much.
Thank you, madam. It was my pleasure.
And we need your support, sir, for data analytics course and the further programs also. And I would like to say one more thing about, sir. When we started off thinking to conduct the AICT sponsored faculty development program and application of emerging technologies in business, sir only suggested few resource persons, particularly on data analytics, that is HR analytics, marketing, financial analytics, R programming, introduction to big data. So all these sessions are suggested by sir, and sir only approach the resource persons, and sir only fix the schedules also. Thank you for such support and assistance for the department, sir. Thank you very much, sir.
Thank you, madam. It's always pleasure getting back to faculty. So I enjoyed being here teaching 2 sessions. Thank you so much. All the very best for all of you.
Sir, thank you, sir.
Thank you, sir. Participants, the same link you can use for tomorrow also. Tomorrow also the session will start at 10 a.m. Please join before 10 or 15 minutes early, so that we can start the session without any delay. We need your support to conduct the program smoothly. So please cooperate. Don't ask for feedback links and attendance links in between. We will post you. Don't worry. So we will consider your problems and issues related to the network also. That's not a big deal. But please cooperate and be active during the sessions. Thank you. Thank you, participants. Thank you very much.